It's November 8th, 2022. Sam Bankman-Fried is live on a Twitter Spaces call. Reporters are firing questions. He's calm, measured, almost bored. And while he's talking, his company is being buried alive. $4 billion in withdrawal requests have hit FTX in under 48 hours. The exchange has $900 million in liquid assets to cover $9 billion in liabilities. That is not a funding gap. That is a crater. 4 days later, gone. A $32 billion company. Evaporated. Not hacked. Not wiped out by a market crash. Stolen. Here's the thing. The man who did it wasn't some shadowy criminal. He testified before Congress. He appeared on the cover of Fortune magazine. He publicly promised to give away every dollar he ever made. He wore the same cargo shorts to every meeting. He slept on a beanbag in the office. And the whole time, he was spending hundreds of millions of your money on Bahamas real estate. So how do you convince the entire world, including possibly yourself, that you're the good guy while secretly robbing millions of ordinary people blind? That's what we're here to figure out. Sam Bankman-Fried was born in 1992. Both his parents were Stanford law professors. Growing up in that house, you don't just hear dinner table talk. You hear dinner table philosophy. Specifically, utilitarianism. The idea that the right action is whatever produces the most good for the most people. He took that seriously. Physics degree from MIT in 2014. Then a job at Jane Street Capital, one of the most elite proprietary trading firms in the world. He was good at the work. Really good. And he donated roughly half his salary to animal welfare charities. Not as a PR move. He genuinely believed he was supposed to. In 2012, while still an undergrad, he had lunch with a philosopher named William MacAskill. MacAskill was one of the key figures behind a movement called Effective Altruism, EA for short. The pitch is simple. Don't go work at a charity and be broke. Get filthy rich first, then fund 100 charities. Maximize impact. SBF didn't just buy into this. He became its poster child. 2017, he quits Jane Street, founds Alameda Research, a quantitative crypto trading firm. Then in early 2018, entrepreneur John Tallinn, a co-founder of Skype, provided a substantial loan to the business. In April 2019, SBF launches FTX, a crypto derivatives exchange, first based in Hong Kong, later relocated to the Bahamas. By 2021, FTX is valued at $32 billion. SBF is everywhere. Magazine covers. Congressional hearings. He donated $5.2 million to Biden's 2020 campaign. And in the run-up to the 2022 midterms, he gave around $80 million to political causes. Some reported publicly, some funneled through dark money groups. The press called him the JP Morgan of crypto, the responsible one, the adult in the room. The image was immaculate. Same scruffy t-shirt and cargo shorts to everything, including meetings with senators. Beat-up Toyota Corolla. Constant talk about how much he was going to give away. Meanwhile, FTX had quietly purchased at least 19 properties in the Bahamas, worth $121 million, including a $40 million penthouse. His parents received a $16.4 million property listed in the books as a vacation home. Same t-shirt though. So, now here's where it gets interesting. And by interesting, I mean deeply, quietly criminal. FTX and Alameda Research looked like two separate companies. They were not. SBF ran both. And he installed Caroline Ellison, his on-again, off-again girlfriend, as CEO of Alameda. That's detail number one. Detail number two, FTX had its own cryptocurrency token called FTT. Alameda held enormous quantities of it, $3.66 billion in FTT on its balance sheet, and another $2.16 billion posted as collateral. These were the valuations on paper at the time, which matters because of what was propping them up. Think of it like this. Imagine a bank that prints its own monopoly money. Then its investment arm uses that monopoly money as collateral for real loans. As long as everyone agrees the monopoly money is worth something, the whole thing holds. The second someone says, "Wait, this is just paper," it all collapses. That's what Alameda's books were. A house of cards built on a token that only had value because FTX said it did. But it gets worse. FTX quietly gave Alameda an unrestricted line of credit, backed by customer deposits. More than half of all customer funds on the exchange were funneled directly into Alameda's operations. That was explicitly forbidden by FTX's own terms of service. The thing every user agreed to when they signed up. And what did Alameda do with that money? High-risk trading, venture investments, political donations, the Bahamas real estate, not generating returns for customers, not protecting the funds, just spending. By mid-2022, the whole was approximately $8 billion. Drop a comment. If you'd had money on FTX at this point, at what stage of this story would you have got out? For a while, nobody outside the inner circle knew any of this. Then, on November 2nd, 2022, a journalist named Ian Allison at CoinDesk published a story. He'd got hold of a leaked copy of Alameda's balance sheet, and what it showed was stark. Alameda's single largest asset wasn't cash. It wasn't Bitcoin. It wasn't even a real currency. It was $3.66 billion of FTT, the token issued by its sister company. Evidence presented at trial later suggested SBF himself believed Binance had leaked the document deliberately. The immediate reaction seemed manageable. Withdrawals spiked, but FTX appeared to hold. What the article had actually done was send a signal to every sophisticated trader in the world. Alameda's entire foundation is a token that FTX can print whenever it wants. That's not an asset. That's a fiction. 4 days later, Changpeng Zhao, CZ, the CEO of Binance, posted on Twitter. Binance was liquidating its entire FTT position, 23 million tokens, around $580 million worth. He cited recent revelations, and that was the match. CZ and SBF had history. Binance had been an early investor in FTX, and SBF had bought them out in 2021 for $2.1 billion, partly paid in FTT. So CZ was sitting on a huge bag of the token, and now he was publicly dumping all of it. The moment that tweet went out, FTT's price started falling, and FTX customers started running. Within 24 hours, withdrawals were approaching $1 billion. Within 48 hours, $4.02 billion. FTX had nowhere near enough to pay. The walls were closing in. SBF reached out to CZ directly. On November the 8th, Binance announced a non-binding letter of intent to acquire FTX. The announcement briefly steadied the market. People breathed. Then Binance's due diligence team looked at the actual books. They walked away the same day, citing mishandling of customer funds and active US investigations. SBF spent the next 72 hours on the phone, calling investors, sovereign wealth funds, rivals, anyone who could write an $8 billion check in 72 hours. Nobody came. November 11th, 2022. FTX, Alameda Research, and 130 affiliated entities filed for bankruptcy. SBF resigned as CEO. He was replaced by John J. Ray III, a restructuring specialist who had previously overseen Enron's collapse. Ray's first public statement about FTX. "Never in my career have I seen such a complete failure of corporate controls." That's from the Enron guy. Let that sit for a second. December 12th. SBF arrested at his Bahamas penthouse by the Royal Bahamas Police. Extradited to New York 9 days later. 3 of his closest colleagues, Caroline Ellison, Nishad Singh, and Gary Wang, pleaded guilty and agreed to cooperate with prosecutors. A 4th colleague, Ryan Salami, also pleaded guilty, but did not cooperate with the prosecution and did not testify at trial. The trial opened in Manhattan in early October 2023. Caroline Ellison took the stand and testified that SBF had personally directed her to fabricate 7 spreadsheets, fake documents designed to deceive Alameda's lenders, into thinking the company was solvent. Those documents were later described in court proceedings as central evidence in the case. SBF took the stand in his own defense. His argument: I made mistakes. I acted in good faith. I didn't commit crimes. He was calm, measured, almost bored. Sound familiar? November 2nd, 2023. Exactly 1 year after the CoinDesk article broke, the jury came back, guilty on all 7 counts, including conspiracy to commit wire fraud, and conspiracy to commit securities fraud, commodities fraud, and money laundering. March 28, 2024. Sentenced to 25 years in federal prison. Ordered to forfeit $11 billion. Here's the aftermath. Customers were told they'd be repaid, in dollars, at the value of their holdings on the date of the bankruptcy filing, plus interest. Which sounds okay. But here's what that actually meant. Crypto went on an absolute tear after that. The people who trusted FTX missed the entire bull run. They got their nominal dollars back. They didn't get back what those holdings would have been worth. The CFTC obtained a $12.7 billion judgment against FTX and Alameda. Caroline Ellison got 2 years, served 14 months, released January 2026. And then there's the bit of this story that doesn't get talked about enough. Before FTX collapsed, SBF had spent around $80 million on political donations. He'd hired at least 13 former CFTC officials as lobbyists. He was actively shaping the legislation that would have governed him. There was a bill, critics literally called it the SBF bill, that would have handed the CFTC, not the SEC, jurisdiction over crypto exchanges. The CFTC, the agency packed with his former employees. When Congress held hearings after the collapse, regulators couldn't even agree on who had authority over FTX. The CFTC said it had no jurisdiction beyond regulated entities. The SEC said crypto was securities. FTX fell between both. $8 billion slipped through a gap that its own founder had helped keep open. And then there's effective altruism, the movement McCaskill helped build, the philosophy that shaped SBF's entire public identity. Earn to give. Sacrifice now for a better future. SBF's donations to EA causes, the ones he used to justify his existence, to explain why accumulating billions was actually noble, were funded in part by stolen customer deposits. McCaskill publicly distanced himself from SBF around the time the bankruptcy was filed. At sentencing, SBF's own lawyers argued something worth sitting with. Their defense rested in part on the claim that he genuinely believed he was doing the right thing, that he'd convinced himself the whole thing was just a bridge to a better future, that the borrowed billions were temporary, that the end justified everything. Maybe that's true. Maybe it isn't. The evidence never fully settled it. What the judge focused on was something colder: the calculation, the willingness to keep going, the lack of remorse. But here's the thing, and this is what lingers. The most dangerous people in a room aren't always the ones lying to you. Sometimes they're the ones who've already lied to themselves, who've built such a convincing story inside their own head that the theft doesn't feel like theft. The fraud doesn't feel like fraud. It feels like necessity, like sacrifice, like a temporary problem on the way to something great. Sam Bankman-Fried told the world he was giving everything away. And in the end, the only thing he gave away was everyone else's. If you want more breakdowns like this, real stories, real failures, real money, subscribe. I've already got the next one lined up, and it's wild.